Why don't we start this week with some pictures that sort of caught the tone of the week? I watched this one live, and it was so funny. As Trump started talking, Powell was just shaking his head from side to side, saying no. Look at the look on his face. That's a guy who just, he is zoned out. He doesn't want to be there. He knows this is a waste of time. Trump tried to pass off the costs up to 3.1 billion, and Powell just kept shaking his head no. And then Trump pulls the Oval Office gotcha moment where he comes with documents and he hands it over. But Powell called him out on it. You're including a building in there that was finished 5 years ago. Yeah, but it's part of the overall cost. No, it's not. It was built 5 years ago. How many times have we seen that played? That was a great scene. And then for those of you who have South Park, WOW, right? Wow. As soon as they get their $1.5 billion from Paramount, they came out swinging. Anyway, some some interesting visuals. What's good for the goose is good for the gander, right? Trump likes making these kind of videos. The last one he made, a president made and put out of Obama being arrested in the White House, in the Oval Office in the White House while he was sitting there smiling. Trump sitting there smiling, and Obama being forced to the floor and handcuffed. A president doing this. This is who he is. So okay. There he is right there. There's another shot of him there, right? And of course, there was the South Park scene. If you are a South Park fan, you'll notice the way Trump's character speaks with the half head opening up and down. That is reserved for Canadians. So, and not even allowing him to be an American character, making him Canadian. With a really small penis. So we'll see where that goes. Another funny picture I saw this week was this one here. I don't know if anybody else saw it. This was on Bloomberg. And look at the name. Catherine Judge. What does she do? Columbia Law School professor. A judge. A Columbia Law School professor. That's funny. That's like somebody named Mr. Green running a solar company, or somebody named George Formalwear running a tuxedo rental company. Catherine Judge, the judge, Columbia Law School professor. I don't know. I find that kind of funny. It's like, you're kidding me, right? That's really your name? Like my dentist's name is David Smile? It's like, you're kidding, right? Anyways, let's get on with the week. Okay, we have a crazy week coming up on both the earnings calendar, the central bank calendar, and the economic calendar globally. When I was going through what was coming up this week, I thought, you got to be kidding me. Like, this is unbelievable. I don't think we've seen a week with this much going on. Anyways, let's look at where we are on rates and yields. Money market rates, all well behaved, not doing anything, and they're not. Capital market, look at that on the 20 and the, that's a bad color on gray, and the 20 and the 30, 8 basis points, not much, sitting just under 5%. 10 years still under 4.5. This is a big week for the long end of the curve, both from the Treasury and from the Fed. We have Treasury refunding this week. You have the estimate being released Monday with the types or where on the curve the issuance is going to be on Wednesday. So let's look at what we have this week. Wednesday, the big one, FOMC, and we went from 95.3 to 97.4 of nothing happening. I do really think that they should be cutting, but they're not going to because it'll look political. I think they're going to lead into this. I think September is the cut. I think they will allow a couple of dissents this time around, with the 25 basis points being in September, to sort of have that progression, to try to look as unpolitical as they possibly can. And unfortunately, we do have to blame the administration at this point for the high rates, because they have made it political. I mean, you could have said, I think the central bank has permission to cut, and leave it at that, and you probably would be getting a cut. But by demanding that the central bank bend to your will, if they do, even if they have permission, the market will have that suspicion that, this looks political. Or maybe they won't, I don't know. It really comes down to how Powell can handle it in the press conference. I seem to think that if you allow for dissents this time and the cut in September, and as was said by one of the central bankers, it's only 6 weeks. But his argument was, look, it's only 6 weeks. If you're going to wait 6 weeks, you may as well do it now. And the other side of that is, well, why do it now? It really is only 6 weeks, and it may be the better way to go. I think the market has it right on the odds, but I think the central bank has it wrong on no cut at all. Look, you got to get that interest expense down. There is an old adage in finance that says, if you have a cash flow problem, that is your only problem. And the U.S. is on the doorstep of a cash flow problem. These continuing deficits, as far as the eye can see, the average cost of the debt over 100 basis points higher in a matter of 5 years on debt that is doubled over that period of time. That's unsustainable. You either solve the cash flow problem and risk, not guarantee, but risk some inflation, or have no inflation but hit a wall in terms of cash flow, right? Goods trade balance, just the goods trade balance you get in 2 days for June, an advanced look at that. GDP, we get in 3 days, Q2 advanced look for GDP, along with Mexico, Germany, Italy, and the EU, all reporting their advanced look at GDP. On that same day, Wednesday's a busy day. You start with all of this, the Europeans reporting overnight, U.S. and Mexico at 8:30. You have the Bank of Canada rate decision that morning. You have the Fed that afternoon, and you have the Bank of Japan that evening. Next day, PCE for the U.S., along with CPI in France, Germany, and Italy. Canadian GDP, June, a preliminary look at June, is Thursday as well. The backdrop of all this is a jobs week. You get JOLTS in 2 days, ADP in 3 days, initial claims in 4 days, jobs report in 5 days, along with ISM manufacturing. You also, on Monday, get an estimate of Treasury refunding. And on Wednesday at 8:30, along with all this other data, you get the tenors that they plan to release. Monday's got a 5-year note auction. Tuesday's got a 7-year note. They're not really market moving. Reserves still sitting 3.3. Reverse repo still over 100 billion, and TGA down at 333. It is a full week, and now throw earnings on there. You got about 160 companies reporting earnings. Monday's the slowest day. After that, every day, bang, 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 bang. Wednesday's the big day. Who knows what's going to happen? It would be an interesting week if you had a 25 basis point cut from the Fed. As far as Bank of Canada, no one's expecting anything to happen. It was a strong jobs report. The last jobs report was very strong. No one's expecting anything to happen here. No one's expecting anything to happen here. I don't know about Bank of Japan. Let's look at Fed funds futures. Q3, 17 basis points. Sort of split between one cut versus no cut. I seem to think September is probably going to be your cut. You're going to get a cut. You can't continue on with members of your own committee starting to dissent and say, look, we think it's time. The data suggesting that it is time. Given what we saw in PPI, PCE is going to be rather benign. We get that the day after the Fed. You get the jobs report on Friday after the Fed. But the Fed has said before, when there's big data reports in the same week, they do get it early. So that might influence them. 17 basis points. Q4, 27, basically one cut. So we're at 44 basis points. Q1, another 20 for 64. That's about 2.5 and 6. We've gone from 3 and 6 to 2.5 and 6. If you go all the way out to October of 2026, 10 meetings, only 4 cuts, 105 basis points. 4 cuts in 10 meetings. I think that's wrong. I seem to think January is wrong. If you get exactly what the SEP says, your October should be 95.92 and your January will be 96.17. So if you think, well, the committee said 2, so chances are they'd be willing to vote for 2 as you go into the end of the year, because that's what they said. That's where they are on average, so we can expect that. Then there is money to be made here on the October contract, because we're closed 95.84, and there's money to be made on the January contract to 96.17. The evidence so far, and based on earnings that we've been hearing about the tariffs, is the thinking was it would be split a third. The exporting country or the company there would try to absorb a third of the tariff through lower pricing, cost rationalization. The importer would absorb about a third of it through, again, lower costs. And then the consumer would absorb a third of it through higher prices, while the government gets 100% of the tariff. Still gets 100%, but it's not the American citizen paying 100% of the tax. They're only paying 66% of the tax because, if we follow principles from economics, the household is the owner of all factors of production, even businesses, because all the shares are held by households somewhere, that the household is burdened with 66% of the tariff through lower corporate profits, because that's part of household income, or through lower, higher prices when they buy, which lowers their real disposable income. But you're getting tax cuts, the extension of the tax cuts. So all the tariff really does, if we think about it, is it smuggles in a tax into either your cost of goods sold or the price that you pay, rather than calling it a tax. And if lying helps make the medicine go down easier by saying the other country pays the tax, because many people believe that the other country is actually paying the tax. That's not true. Parents lie to their kids. No, the medicine doesn't taste bad. It tastes good. Open wide. Because that's the thing that needs to be done. You have to pay this debt. You have to pay these bills. You gotta get money from your citizens somewhere. And tariff is, it's just another consumption tax, except it's a consumption tax on stuff that's imported. I do think there is money to be made in the Fed funds futures. Fed funds futures is a reflection of the central bank, not of the market. There is no sentiment in the Fed funds futures. On the long end of the curve, that is the market making decisions about, I'm not getting paid enough. Okay, now I'm getting paid enough. Who wants to buy at these particular yields? That's all supply and demand in the market plus sentiment. The Fed funds futures is not sentiment driven at all. It is central bank. It is absolutely objective in its price. It is whatever the average of the Fed funds rate is over the course of the month. That's why we use October. October is a clean month because there's no central bank meeting, which means the effective federal funds rate should be the same every single day. once you get out to October of 2026, starting in May of 2026, you got a new chair. Plus, you have to understand the network effects of having two people who are arguing for a rate cut, and the effect they have on those around them, and the probability of having somebody in that network also flip over. There is lots of work in network theory, in economics, looking at systems, and when you take a system, a stable system in equilibrium, that doesn't mean that everyone agrees. You could have a couple of mutations in the system, but wherever these nodes are, there are nodes around them. And whenever you have a mutation in a system, through simulations, you can assign a probability that it can affect or infect, one of the neighboring nodes. And usually you give it about a 20% probability, such that at each iteration of the simulation, there are the mutations do affect those around them, which means the next state you might have a couple more. Still a system in equilibrium. It's not until you get to about 20% of mutations in a system that it does then begin to flip to the other side. So if we think about 20% on 19 people on the FOMC, that is 4. You have 2. You're halfway to that tipping point where it then begins to infect the system. Right? So the bet on Fed funds futures is a bet on that. Now you replace the chair with someone. By the time you get to May, you might have 3 or 4 people on the committee that say, yeah, we should be cutting rates more. You get a new chair that agrees with that as well. I think that's your tipping point. You have 4 more meetings after that. I would seem to think you get 25 basis points at each of those, which means the October is mispriced. Because I think you could probably say there's 175 to 200 basis points by next October instead of 105. The central bank is going to have to change the focus of its data. It's looking at full employment and it's looking at inflation. If it wants to play the chess game and play 3 or 4 moves out instead of just playing the data that's right in front of its nose, I feel that they're playing checkers right now. If they do want to play the chess game, they do have to look at the sheer amount of interest expense going out and the threat that that poses to economic growth. They're going to have to start looking at that. And if you can't rely on the fiscal to do the right thing, which is dramatically cut costs and dramatically increase taxes, then you're going to have to dramatically cut costs for the government by lowering that rate and risking inflation. And the argument being, well, listen, you don't want to raise taxes on your citizens. Inflation is a pernicious tax, but they're going to pay tax somewhere. Inflation will help inflate away the debt by making nominal GDP that much higher. We'll get the interest cost down, so the cash version is a lot more palatable. There isn't that much cash going out. And then we'll deal with the inflation later. But when you have a cash flow problem, that is your only problem. Anyways, we'll leave the screen, but just keep this in mind. This is a busy, busy week. So have a look at real yields. This is nice. You got a 10-year below 2%. All of the real yields just following consistent with the long end of the nominal yield curve, and break-evens really doing nothing. Same with OAS over here, really doing nothing. Nothing to see here at all. Contracting just a little bit across the entire credit spectrum, except AA holding tight at 0.44. As I said on the previous screen, you have the Treasury refunding estimate. This will be just a big number like 400 billion. I don't know. I'm just making that up off the top of my head. I don't know what the number will be. Monday at 3. And then on Wednesday, it'll say, okay, well, money market will be this much. The 2-year, the 3-year, the 5, the 7, the 10. It'll sort of give you numbers for each tenor. Let's try to make sure that's not lost in all of the data. Auctions this week aren't really risky for the curve. This is your big risk event for the curve. The size is not going to be as important as the distribution. I expect if the size comes in big, it will lean more toward the money market than the long end of the curve. Case-Shiller housing price index get on Tuesday. This is for the month of May, a little bit backwards looking. DHI. DR Horton Q3 25 earnings release, average selling price 369.6, down 3% year over year. Sales incentives trending higher. They're focusing on affordability by building smaller square footage homes, but this will drag down the price of existing inventory, along with you still have a very elevated 30-year fixed rate mortgage, even a 15-year up at 6%. It's more. It's when I say more expensive on a cash flow basis. It is higher because you're amortizing over 15 as opposed to 30 years, so your principal payments are much bigger. But it is a cheaper mortgage because you're some 90 basis points lower on your interest expense and only amortizing over 15 years. But that's a big mortgage, right? I seem to think that more people today would probably side with a floating rate mortgage as opposed to a fixed rate mortgage for 30 years. Or maybe they take fixed rate and after a couple of years when rates get lower, they just refinance and pay out. I don't know. I seem to think both in Canada and the US, the floating rate, if I had to pick a mortgage now, I'd pick a floating rate mortgage. But we do have this on Tuesday if you're in the housing sector at all. The big threat to the housing sector obviously is the 10-year, right? You got to get that 10-year down. You get that 10-year down, mortgage rates will follow. If that happens, then housing activity will pick up. Although with the earnings this week, the home builders had one hell of a rally. DR Horton was up some $20 on the earnings, but if you look at the release and you look at the metrics year over year, it is a on a year over year, sure it beat expectations, but the trend is not one of solid recovery. It's still, the metrics are down year over year. The inventory of homes that home builders are sitting on, it's like a 8-9 month inventory. That's why DR Horton is saying, our sales incentives are trending higher. You don't sit on that stuff. You have to move that stuff because it costs you money to sit on it. So I think the rally was a little premature. I think it was a relief rally. Look, the market's hitting all-time highs every single day. It seems it just keeps going higher no matter what. So why should housing pay attention to any bad news if no one else is going to in the equity market is paying attention to bad news? If bad news shows up, the housing market could say, whoa, stop. That belongs to the bond market. Only good news here. Only good news. You take that bad attitude and you get out of here. Let's talk about copper. This is a 6-month chart. This is the white ranges where I think U.S. copper really does belong. If you didn't have any of the tariffs in there and it was really just reflecting where we are in terms of supply and demand, a small premium, the U.S. premium, a small premium to the LME, 450 to 480 is the range. We're 584. It tried to push up to $6. This is the threat of 50% tariffs on copper coming into the U.S. So you have this huge U.S. premium. That 50% tariff, as I've called it before, I think if you try to find the stupidest tariffs, and here you got to spell it with two O's because it's not stupid, it's stupid, right? If you need to build out your energy grid, and the U.S. does, they've got to double over the next couple of years, up to 2030. You have to double the capacity because you have so much that's moving to the grid. You have more EVs that are being sold. You have data centers, and they're not going away. Cloud, that's not going away. You have these big loads that are coming on, and we're moving more and more and more into a digital world. You have no choice. Why would you purposely make your country the most expensive country in the world to build electricity grids in? Why would you do it? You've gotten rid of the incentives for green energy. You've gotten rid of that, so you've made that more expensive. And now you're going to layer that on with copper, the one thing you absolutely freaking need. So I seem to think that that is an empty threat for August 1st. I don't. I see this getting kicked down the road. That it will be something like it will phase in sometime starting in 12 months over a period of 2 years. And you need to start building smelter capacity in the U.S. because you can't just move your copper mines to the U.S. I think even this administration must understand that. I mean, fingers crossed that they do understand that, right? So you can move smelter capacity here, but the world's got a lot of smelter capacity. But you could move it here, although I doubt it, because what if this all goes away in the midterms? What if this all goes away in 4 years? But if you make an announcement, that just might be enough. Trump really only wants the announcements. I don't know that he has any follow through on anything after the fact. Big announcement on SoftBank and OpenAI. And if you look at where they are now, it looks like that's not even going to happen. That $500 billion is looking like it's just not going to happen. The announcement's the big thing. Give Trump a victory. I seem to think this will be kicked down. This can will be kicked down the road. He won't remove this sword of Damocles. It'll keep hanging over the heads of Americans, but he will just move it because it is really, really, if you had to list all of the tariffs, this has to be one of the stupidest tariffs that you can come up with. 440 on LME. You get a 50% tariff that puts you at 660 US in the US, which would, again, like I say, stupid, but October 26, 95 days to expiration, 650 calls. I've sold 7 of those. I think I got 12 cents for them. That would put me at 662, just on the other side of the 660. I've sold 675 calls and a $7 call, so I have 11 of these. Doesn't sound like a lot, but keep in mind that each of these contracts is for 25,000 pounds. So every 10 cents is $2,500. If you're wrong by 10 cents, if this goes to 672, my break even here is 662 on 7 of these. I lose 7 times $2,500 on that. So that's why the number is small. It may look small, 11, but you have to multiply 11 by 25,000. I'm basically making a bet on 275,000 pounds of copper. I am long-term bullish copper still. This is just the result of tariffs. This is not fundamentally driven. I am still long-term bullish. Given where we are in the cycle, at any other point, you'd see copper probably around 3 to 350. That it's LME at 440 US, and I think 450 to 480 says something. Freeport Q2 2025, they reported copper production is down 7%. So even though the numbers looked good, if you look at actual production, which is really the important thing, it's down 7%. You think with elevated prices for both gold and copper, why would you be down 7%? Lower ore grade went from 0.36 a year ago to 0.28. That is a big drop. A big drop. So you think how many more tons of ore do you have to process just to get the same copper? What does that do to your costs? It sends your costs up. And if you have a limit on the amount that your crushers can do without building out more capacity there, then this is what you end up with. Copper production would be down, even though ore crushing, the productivity of the mine could be up. You could be crushing a lot more ore, but still getting a lot less copper because the yield has gone down. All the mines out there have reported lower yields. Capstone Copper, Codelco, BHP, lower head grades. Head grades is where they are in the mine and taking out copper. Not deeper. Like as they go deeper, they might have different grades, but right at the head is lower. And you have no big finds coming online and no big mines, just a lot of brownfield capex, meaning taking existing mines and expanding existing mines. Well, that has a cost. So I don't want any of the income statements from any of the miners, but I do want the revenue, which means I just want the price of copper without the cost of getting copper out of the ground, because it is just getting more expensive. That means that the copper price has to go up, because if it gets more and more expensive to get it out of the ground, without the copper price rising, you know where it's going to stay? In the ground, creating a shortage of copper, which would then drive the price up, thereby incentivizing mines to start getting copper out at those higher prices, because it will come with a higher cost. Look what's going on with inventories here. I think this is a dangerous setup. I would not be chasing price at this point. I would not be shorting the copper contract either. At 580, I would not be shorting it because it's a big guy. You short at 580, it goes to 610. You're down $7,500 on one contract, and that could happen in a day or two. So I would not short this thing, but I would take advantage of the increased implied volatility, and I would sell the calls at a point where if you did have the 50% premium, the 50% tariff, you'd have a premium to LME. You'd be somewhere around 660, maybe as high as 675. I'd be selling calls, but I do expect this August 1st to come and go, and copper prices to come back down to earth. If you do get this big spike down, IV is going to jump. The put IVs are going to increase dramatically. I will be looking to sell the 480 and the 450s on any big move down. IV will jump. Look at the inventory here. The LME latest inventory, 122 to 124,000, approximately somewhere in there, up 13% month over month. Near a 1 month high, still about 28% below the 5-year average. Shanghai, really low, down week over week, 2 month low after a sharp June decline. But look at what's going on in New York, 217 to 234 versus LME at 122 to 124. You're basically double. Multi-year highs and still rising, highest in 7 years. 55% of global exchange inventory sitting in New York. Why? Because if you deliver to New York, look at the premium you get. So empty out the warehouses in London and Shanghai and get them into the US before the implementation of any tariffs and get the higher price. This is a big arbitrage play. Be careful with this price going into August 1st. Let's see what happens August 1st. Again, I wouldn't short this, because if that tariff does stay in place, it would be consistent with the stupidity of this administration, making it up as they go. I don't think they really understand what they're doing. It would be consistent. That also makes it dangerous to short. Although I think it would probably stay at the 50% premium. I think I'll be okay at the 650, 675, and 7. I hope. My best guess is that, again, this is so stupid that even this group of people must recognize this is stupid and it's not going to happen. And if it doesn't happen, you have two problems. Problem number one is this premium. will go away very quickly. Problem number 2 is you got a huge inventory overhang. Highest in 7 years. A huge inventory overhang, which means typically you have a US premium. You could, for a while, have a US discount. So it could get under 440. You might even see as low as 420, 410. But I will start taking my first stabs at it at 480 and 450. If it keeps going down, I don't mind, because at those low prices, looking at what's going on with ore grades and with production, just yields, you got to be long-term bullish on copper. And if you can get it under 440, that to me would be my highest conviction trade. I would load up, because I think I have a couple of tailwinds here. Tailwind number 1 is you have lower production going into what I think is going to be increased demand without the ability to increase supply. Tailwind number 2, lower interest rates always increase investment in capacity. Everything needs energy. GDP is energy intensive. You get a decrease in interest rates and an increase in investment, that is going to be energy intensive. And finally, the US dollar, I think, is in decline for some time, which means the US dollar price of copper will go up as well. So there's a lot of tailwinds to be excited about. If we can get past this tariff thing, if I'm right on August 1st and it gets kicked down the road, some of this premium is going to come out. Implied volatility is going to jump. I'll take the opportunity to sell these puts, keeping in mind that you got a big supply overhang going on right now. Okay, S&P 500 Friday closing another all-time high, 637.35. Look at this, all-time high, all-time high, all-time high, all-time high, all-time high, all-time. Every day this week, actually other than Monday, Tuesday, Wednesday, Thursday, Friday, all-time high, all-time high. Triple Q's all-time high. Small caps just not coming along, but they need lower rates to really start to get some interest. And I think, really, even though they're lagging, it's a nice opportunity to build a base. I think they're the bigger beneficiaries, dollar for dollar. If you think about it as a leverage play, I think they have more operating leverage towards AI than the larger companies do. Forward 4-quarter operating earnings 281.37. That is the first bump up we've seen in a while. Closing SPX 63.88. So the market is more expensive this week than it was last week. 22.7 times forward versus 22.42. Lots of companies reporting this week. 162 or 160, depending on which one you prefer. And I know last week, when I went through the list of companies reporting, I went through the list of companies reporting this week. So there's no point in going through the list of companies that are reporting this week, because I did that last week. And I thought, well, this week, why don't I just go through the list of companies that reported last week just to make up for it? But that's old news. This yellow line over here, this is, if you grab the bottoms of the last trend and you carry it forward, you could see that it was hitting this line of resistance, and then there's the breakout, and then it's just running. So you can look at the distance above here. It's kind of, can only get so high above a trend before market participants start saying, what's our catalyst to go higher? We look like we're all in. And you have more and more, at least when I listen to Bloomberg, more and more coming on saying we're nervous, we're cautious, we're nervous, we're cautious, yet it just keeps going up. So they can't be that nervous and they can't be that cautious. And you think, well, they're probably just buying a whole bunch of puts. And if they were buying puts, it would push the put price up and it would show up in implied volatility. Nope. 0% in terms of percentile. What this is saying is that if you look over the last 13 weeks, implied volatility has never been lower. All-time highs on the market. No fear in the puts. But yet, everybody that gets on Bloomberg is saying, pretty much singing from the same hymn book. We're a little out over our skis. Valuations are stretched. This was short covering. This can't hold. We're in bubble territory. This is getting dangerous. But here we are. If that were true, you'd see some footprint somewhere from all these people saying we got to do something. So there is what people say and there is what people do. And there is that saying on Wall Street, if you really want to know what somebody thinks, don't listen to what they say, look at what they hold. All-time high. All-time high. No implied volatility. Corporate spreads at multi-year lows. There is no fear out there. I don't see the market waking up on Monday saying, oh my God, you're right, let's go down. There would have been some preparation ahead of that, and there isn't. The contrarian view is that's exactly when you want to expect a correction, is when no one is positioned for a correction. That means everyone's on the same side of the trade. What's left to do? Where do you go from there? And I would seem to think that with all the data that we're expecting this week, Monday, I wouldn't expect much on Monday other than some wiggling around. And I think the data will dictate what we see. Q2 GDP is going to be a big number. The Fed and the press conference are going to be a big deal. PCE and jobs reports are going to be big, and then you have earnings. They're not all going to land on just one side. Earnings have been pretty good so far. So it is a big week of risk, considering that the market right now has priced in almost no risk into the equity market, almost no risk into the corporate spreads, but nothing but risk in the Treasury market. Okay, 2 points to talk about here. I didn't think they warranted their own screens because it's really just sort of just an opinion piece here. Let's talk about the trade. I hate to use the word deal, so I'm going to use the word term sheets. The trade term sheets. The most recent one with Japan, the 15% tariffs and the $550 billion investment that Trump gets to decide where it goes. 90% of the profits accrue to the U.S. government. And it is in the form of loans or guarantees for projects, again, that Trump agrees, says do this, do that. And there's some thinking that that is the seed capital for the sovereign wealth fund. These are term sheets. These are not deals. That does not mean that tomorrow Trump can say, okay, Japan, we need $100 billion over here. This is not a done deal. This is an agreement. We agree on this term sheet, which is the beginning of our negotiations. It's the same as when I sold my business to private equity. You have some conversations, you come up with some rough ideas of a valuation multiple, and there's a term sheet that's given. And that term sheet starts the due diligence process, and things could fall apart very quickly in due diligence if you can't produce what you said you had. So this is usually a 90-day period, 60 to 90-day period of a really deep dive. The term sheet is just, okay, if you like everything you find, this is the agreement in broad strokes that we have. But those things, as the due diligence unfolds, they try to nudge it one way or another. These are term sheets. Look, this could all go away. July 31st, U.S. Court of Appeals for the Federal Circuit is hearing the appeal from the previous ruling from the U.S. Court of International Trade, which blocked the tariffs, saying they are illegal. Then there was an appeal, and the Court of Appeals allowed the tariffs to stay in place while they heard the appeal. They hear that July 31st. Here's what's going to happen. If there's a ruling against the Trump administration, it's because you have radical left-wing judges who have gone rogue, that they are disasters, and they hate the U.S. Because what else could it be, right? The administration will appeal, most likely, to the Supreme Court, and the tariffs would stay in place during the appeal, and the estimate for when the Supreme Court would actually hear it would be June 26th. and it could all go away, especially if you have two courts that have already said, yeah, they are illegal. It would be, well, you never know, right? I mean, he feels he does own the Supreme Court as well, but this could all go away. So that's why I say you have to think of these more as term sheets right now, and it's going through its legal due diligence. Is it legal for the president to have this much power over tariffs? You know, he's 6 months in, 6 months. And had he on day one said, listen, we need to raise tariffs, and what we're going to do is we're going to do 50 basis points per month, every month for the next 2 years, right? You'd raise your tariffs slowly. There would be no dislocation anywhere. No one would disagree with that, and you'd be 3% higher right now without any issue at all, without anything, and probably a few cuts from the central bank, or at least a certainty of a cut this month. However, the administration doesn't have the power to do that. That is Congress. If you're going to do a tariff policy like this, you got to go through Congress, and of course, dictators don't share power. So you have to turn it into something else. You need a shit show, because you have to demonstrate that what is going on right now is a shit show. And we have to end the shit show because it is damaging to the U.S. It's against our national interests. It's a threat to our sovereignty. You had to turn it into a shit show, which means you needed a Trump. Only a Trump could get this done, because it's the only way to bypass Congress, is to turn it into that. But you had one court that says, too much power. Let's appeal on July 31st. By about mid-August, you'll get a decision here. If they say you're right, too much power, tariffs stay in place, it will go to the Supreme Court. So it will not be over. Going into the end of this year, you will have tariffs, whether agreed to by the Court of Appeals or declared illegal by the U.S. Court of Appeals. Tariffs will be here until the end of the year, no matter what. Question is what will happen by mid next year. June 26th is a whole year away. And then you got midterms November 26th. I was seen to think that given the trajectory that the administration is on, they're not going to do well on the midterms. But Wall Street Journal had had some data up showing that the approval rating for Democrats is the lowest in 30 some years. Not, you got to go back to the 90s, early 90s to get approval ratings this low. But even going back to the time when you had approval ratings this low, Bill Clinton won. He did win. So you do have midterms coming up by November. So as far as these trade deals and what I think about Japan and all this, I think I think countries are smart to give Trump a public victory, and behind the scenes, nothing has to come of it. Trump just really wants the show. Give me the show. Let me come out and declare victory, and that's all I think that's all he's really interested in. Otherwise, rather than talking this weekend after being booed out of Scotland, after talking this weekend that he wants to be the one to broker a deal between Cambodia and I don't know, I forget the name of the country. They're getting in a bit of a tiff. He would be focused more on the previous big announcement between SoftBank and OpenAI. $500 billion, that's all falling apart. You think he'd say, hey, you guys, you said you would do this, you're going to do this. He doesn't care what happens after the fact. He wants nothing to do with that, I think. He had his victory lap, came out, paraded some people in front of the cameras. They said, oh, Trump is a magnificent leader and we're doing all of this. That's all he cares about. And I think that's what Japan did. Yeah, sure. Here you go. You're way too good for us. You're way too great of a negotiator. You got us. You got us. Meanwhile, it's just a term sheet. It's not a trade deal. We get this name, this word thrown around, trade deal, trade deal. These are not trade deals. They're term sheets. It would be the same thing as if I had said, I sold my business just because I have a term sheet. No. The sale doesn't come till much later. You have to open that kimono and there's a deep dive, a very invasive deep dive. And then if everything is okay, you've sold your business. So when you get a term sheet, you haven't gotten an investment, you haven't gotten a trade deal, you haven't sold your business. You just have the broad strokes of an agreement that if we go through the negotiations, we have some document that says, look, we broadly agreed to these things, right? Because if you can't broadly agree to something up front, you don't even start the long process of negotiations. These are term sheets, and this could all go away. Let's talk about AI. I've been thinking about this quite a bit, and just looking at the CapEx. Tesla announced their CapEx dedicated towards their technology side of $9 billion on their earnings. I thought, $9 billion? You're not even in the game at $9 billion. You look at Google at $85 billion. You look at Facebook, and I started thinking, you can't win at $9 billion. You're already behind the curve with Grok, and on a very objective basis, Grok doesn't have the size of the data sets, the training data sets that everyone else does, and it leans heavily towards X, which means it's not a very good. It just trails OpenAI. By the way, an update on Grok. It took I think almost 10 days, really, but I did get an answer from OpenAI, from XAI, saying, do you still want your refund on Grok, or are you okay with it? And I said, well, you have access to my account. I'm sure you can see the chats that I've had and the output. Yes, I still want a refund. I've given it multiple opportunities to prove itself, and it can't. So it said, okay, we'll process your refund, expecting about 7 to 10 days. So they must have gotten a deluge of refund requests, and then just figured we got to get ahead of this stuff. Or they've got so many refund requests, that's why it took them 10 days to get back to me. So look for more of that coming out. But I don't see them making it, for the simple reason that they don't have the money. If you throw more money at this and more size and more data, you'll get good. And it's going to follow this curve. It's going to follow this S-curve, the transformer technology, and everyone will end up in and around the same place. By the way, when they release their models, there's a whole bunch of benchmarks. When they release models, they go, look, we're number one on this benchmark. Somebody else releases the model and says, oh, look, we're number one on these benchmarks. Somebody else releases, says, oh, well, look, we're number one on everyone's number one on the benchmarks. Otherwise, they don't tell you. They're not going to say, look, here's 10 benchmarks. We're number one on 3, but on 7 of them, we're at the tail end of the pack. They're not going to do it. Everyone is number one on a benchmark. I don't believe any of those benchmarks. You have to use the stuff to figure it out. When I looked at Research in Motion in 2007, one of the things that jumped out at me, well, there were two that jumped out at me, was the small amount of cash that Research in Motion had. It had $1 billion of cash. Going up against, the closest one was Nokia at the time with $6 billion in cash. Never mind what Apple had, multiples of $1 billion, multiples of it. And their long production cycles. Apple was sitting around 9-month production cycles, and they were out to 2-year production cycles. You can't win a technology war without money and speed. Those are the two things you need, money and speed. Who has the money? Google. They have a business that spits off cash. Meta. They have a business that spits off cash. So you have a closed system and an open system. It is iOS and Android all over again, except now it's flipped. The open platform is now the closed platform, and iOS, Apple, is nowhere to be seen in this fight. If I had to pick the two big winners, if it came down to a foundational duopoly, foundational models, foundational duopoly, I would pick the ones with the most cash, Google and Meta. I would pick them. OpenAI is not public, and they are a pure play AI company, and their cash flow is nowhere near their cash burn. Yes, they have cash flow. Yes, they have revenues. 13 billion is nowhere near their cash burn, and they have to keep raising money. I think they raised $40 billion. That's not enough. That's, you got to do it again and again and again and again. Google and Meta have ecosystems and businesses that generate cash. They can afford it if it comes down to it. And again, it's a transformer technology. Everyone's in on around the same page on this. I use a bunch of different models, and on some tasks, this one's way better than this one. On others, they cluster. It's all fairly close, and there's only so many words in the English language, and there's only so many things that have been written that eventually all of these models will have ingested so much that they'll all be so very close to each other. And it will be the interface and the applications that are built upon it that will distinguish the two. Imagine iOS without any apps, that nobody built apps for the iPhone or the iPad. Even though it was a great technological product, it wouldn't be anywhere because it wouldn't be very useful. Google reports 9 million developers are building on Gemini right now. 9 million. That's really what's going to matter, is what is being built on top of it. I do think that we are in a race to a duopoly with probably two big winners. One, a closed system, one, an open system. There is some value in having the open system, but there is some value in the closed system in that you can control the quality of the entire ecosystem and control the whole experience. Big question marks on OpenAI, Apple, and Amazon. Amazon with Anthropic. Big question mark on this one. I don't know what to expect from Apple. I would seem to think that Apple should buy something. But they're going to need something, or are they? Right? I mean, you could look at this and say, okay, well, maybe they don't need that. Maybe they just need to have whatever model it is, whether it be from Google, from Meta, Perplexity, OpenAI, maybe have that integrated into their systems, and they don't really need to own one. It might be the wise decision if there were 2 utilities serving the town I live in. The last investment I would make would be in a utility, even though I recognize that it's something everybody needs, because there's no money to be made at that point. And I think that's going to be the same thing with these models. They're so expensive to build and so expensive to maintain that you simply can't have 30 of these models. No one provider could get enough subscription revenue to pay for it, nor could you charge the amount that you need to break even. Otherwise, everyone would be paying $2,000 and $3,000 a year instead of $26 a month. So the market is just not big enough for the cost that is required, and the running costs, and just the sheer energy costs of keeping this going. To have 20 different models out there all profitable, at least at the foundational level. So I do think it's a race to 2, and there's going to be a shakeout at some point. Some of these are going to go away or become much smaller, much more focused versions than what they are. I think it is a utility model here. So maybe Apple is playing the right game by saying, look, it's just not going to work out. Everyone's going to spend billions and billions of dollars because there's going to be impairment charges in everybody's future. And in the end, we could just embed this into our hardware, whatever it is, and it will still be what is built on top of those foundational models, the applications that are built on top that probably will determine which one is the more desirable one. So I don't know. I don't know who will eventually win. My suspicion is the big money will win, Google and Meta, but Amazon and Apple are big money too. So could they just buy what they want, and then there's four? If there are, I don't think any of them make money at the foundational model level. It will be how much can they extract from the development going on top of their models, and how much could they extract from the devices of which they're in. Because I'm certainly not going to pay some subscription fee for my hardware and then some subscription fee for my for the AI interface, and I'm not going to continue on with 6 or 7 subscriptions of what I have right now. Eventually, I will be down to one model. Right now, it's looking like it's Gemini. Gemini is in the lead almost on anything I do. When I give it to the others, even if I spend time with the other models and say, okay, come on, like, not this way, let's do it this way. I give it the feedback. I try to get it to where it needs to be. Gemini just does it quicker and better. And if I spend that much time with Gemini, I can make it even better. They have a $340, at least in Canadian, $340 a month package. When you figure that I'm paying for, I think 7 or 8 actually, because I bought one last week, 7 or 8 of these, I'm basically at this amount anyways. And if I pay the $340, I get access to the 2.5 with DeepMind. Now, it's not there yet. So if you pay the $340, you're not getting much more than you get with the $26. But as soon as they say, okay, that is now available, I'm in. I want to check that thing out. You also increase your cloud storage. I have, I think, 2 terabytes. I don't use anywhere near there, but I think it goes to 15 terabytes. As an extra bonus, you also get YouTube Premium. So no ads on YouTube. They bundle that in as well. So that'll be kind of a nice thing. But you have early access to the models, and you have access to DeepMind in there. $340 a month. I would pay that once. I will pick one supplier. Like I have one utility company. I don't need 2 utility companies in there. I got one. Right? You don't even have a choice of 2, because if there were 2, none of them would make any money. I think it's going to be the same thing with these big foundational models. It's going to come down to 2 big models. And China will have its own set of models because that's what it does. But it'll come down to 2 big ones. I think it is Google and Meta. Speaking of Google, let's spend some time with Google. Let me show you how I used AI to do a nice analysis of Google. And we're going to look at a fact sheet. Actually, it's called a prompt sheet, because I think that's all people need to develop these days is prompts. And we're going to use that in conjunction with Perplexity to do our analysis. Okay, I'm showing you a new product that we're going to be putting out there. These are called fact sheets or prompt sheets. And it is 20 points that we should know about a quarterly report. Well, let's go back a year before Notebook LM. What would you do? You'd get the press release, you'd read through that, you get the highlights, you get the 10Q, you can get more detail. You get the investor presentation along with the conference call. You're looking 4 or 5 hours to make your notes and get an idea of where you are. By the time you read the press release, go through the 10Q, listen to the conference call, maybe listen to the Q&A twice. Go through the presentation, make your notes. Download all that and give it to Notebook LM. And ask it for the 20 big points that it would extract. That if we were going to be an analyst and write an analyst report, what are the 20 big themes that it would want to talk about? And it will do it for you. Then you go through it and fact check, because it makes up numbers sometimes. I caught it doing it with Texas Instrument. I gave it all the documents, and it decided for some reason that it got a hold of a URL, because for one of them I just gave them the URL to the investor presentation. Well, it decided to go to the site and it started using Q2 of 2024 for the main points instead of 2025. As I'm going through the points, I'm going, this is not true. None of this is true. Where do you get these numbers from? Well, I got it from Q2 2024. So you do have to fact check it. And then sometimes it just misses some important things. So let me give you an example. You do have to change the way you ask it questions if you have a technology company up instead of a retailer. For a retailer, you want to know, there's some metrics you want to know. Big one is same-store sales, year-over-year same-store sales. Not increase in revenue. I don't care about increase in revenue. So you go through, you said nothing about same-store sales. I need to hear that. For technology companies, it's really about its segments, and especially its faster growing segments. You need to hear about that. So you got to prompt it a little bit. But anyways, this is what I get. And it gives me the big themes all at the same time. Now, if you're wondering why I have this in here, and I have it down here as well, and at the very end I have this, is because we're giving these away for free, and they'll get shared. And if they're going to get shared, understand nothing is free. We got to get some people to pay for the cost of getting this done, so we'll stick a little bit of advertising in here, and if we get some subscriptions from it, there you go. You get something for free, but we got to charge somebody somewhere. Somebody has to pay for this along the way. The goal is to each quarter generate one of these for each company in the S&P 500, which means I have to modify the prompt, at least I think the prompt by sector. So far that's worked out well. If I just have, well, okay, this is a utility company, I got to use these prompts for the utility sector. These are for real estate, because here we need to know different things about real estate. If it's not going to tell me, I have to ask it. Let's go through Alphabet. Alphabet right now is trading. We're going to see here, if we just, without growth, if we just forecast out flat earnings for the next 4 quarters, it's trading at 19 times its forward earnings. The market's almost at 23. 19 times. Let's see if it's justified. There are risks though. Look at revenue. 14% year-over-year revenue increase, 96 billion. That's in a quarter, 96 billion. The expectation was for 93.94 or 94 billion, so 2.5 billion more than expectations. Net income rose 19%, 28.2 billion. EPS at 231, 22% improvement. I want you to look at the leverage this has. We think of these companies as asset light. You're going to look at their balance sheet. They are actually, but 45% of their balance sheet is asset heavy. So they do have operating leverage. You have a 14% increase in revenue, which led to a 19% increase in net income. There's your leverage. It wasn't just, a dollar for dollar to the bottom line. Your revenues increase, your net income increases by even more. That's called operating leverage. Alphabet maintains stable operating margin, 32.4, despite increased investments, demonstrating its ability to balance growth with profitability. So look at what I'm looking at when I'm looking at performance. How did revenue grow? How did net income grow? Do I have operating leverage in there? How did margins perform? Let's look at CapEx. Significantly increased 2025 CapEx forecast by 10 billion. Just the increase in their CapEx is more than what Tesla's whole CapEx is, 10 billion to 85 billion. Signaling a major investment push primarily in AI and cloud infrastructure. Free cash flow, trailing 12-month free cash flow, 66.7 billion. That's 12-month trailing free cash flow. So every year, 60, 70 billion dollars in free cash flow every year. Tesla's quarter, what did they have? 160 million in free cash flow. XAI is private. They're trying to raise money. They're burning through $1 billion a month, even if they raise $12 billion. That's a rounding error on Google's cash flow. OpenAI raised $40 billion, the biggest raise ever. Set a whole record. and Google generates that every 9 months. Do you see how this game is going to go towards those with the cash, and Google has it. Quarterly free cash flow 5.3 billion. Well, because you have increased capex. Even with the increased capex, even with everything they're spending, they still at the end of the day say, look, we got 5.3 billion hanging around over the last year. Let's return that to shareholders. Repurchased 13.6 billion in stock, paid 2.5 billion in dividends, so returning 16 billion dollars to shareholders. When I look at their balance sheet, sitting on a big pile of cash. Sorry about my devices going off. That is just the cost of living in an Apple ecosystem. You have to take all your devices and move them into another room. Segment performance. Google Cloud, 32% year over year. Look at that. Revenue was up 14%. Google Cloud, 32% year over year. Operating margin nearly doubled to 20.7%. So we don't have the leverage working for us here. You had an increase in revenue, but still, so we don't have the scale we need to start seeing the operating leverage. But still, at 32% growth, that's going to come. The cloud backlog. Look at this, $106 billion. Usually, you're going to get 3 to 5 year contracts in here. So what happens is I say, okay, I agree. $10 million over 5 years. Well, you can't recognize $10 million in revenue today. So if I used up 1 year, you recognize $2 million, you have an $8 million backlog. That's money on contracts that have been signed that are coming in. So if we say that's over 5 years, that's basically $21 billion a year. Revenue surged 32% to $13.62 billion. Right? So just think, just the backlog. If we assume they're all 5 years, they could be 2 year, 3 year, 4 year. If we assume they're all 5 year, that's 21 billion. If they're 3 year, you some 33 billion, 34, 35 billion a year. That's a big backlog. I don't know why that didn't get more airtime, I guess is the word I'm looking for. Search, this is the thing that I would worry about with Google is what about search? Because that we're going to look at the income statement and just look at where the revenue comes from. Out of this $96 billion that they reported, 54 billion was advertising, search ads. Core search business delivered double-digit revenue growth, and it did, with new AI-powered features like AI mode and AI overviews driving user engagement. I'm in Canada. I don't have AI mode yet. I get AI overviews. I can see that would drive engagement, but where are the clicks, right? YouTube advertising grew by 13%. Other bets, Waymo. It includes Waymo, not just Waymo. It generated $373 million, but they did lose money. However, Alphabet remains committed to investing in this area. This is the big deal here, AI and innovation. AI is positively impacting every part of the business and driving strong momentum across all segments. You know, you have to ask, well, what does that mean? Impacting every part of the business. AI is doing two things for them. It is driving their costs down. That is why they were able to have stable margins with increased capex. So you have increased depreciation, but you still have stable margins because you're making savings somewhere else. Impacting every part of the business, driving strong momentum. So those are two separate things he's saying. Impacting every part of the business. Obviously, increased productivity, lower need for headcount, and strong momentum. Gemini. This is big here. 9 million developers now building with Gemini. This is a big number here. Token processing doubling since May. It's only July. So in 2 months and 60 days, their token processing doubled in 60 days. 100% increase in 60 days. The Gemini app has over 450 million monthly active users. I don't know that there's been a technology ever like this where just the number of people using it so large, so fast. 450 million monthly active users. Whew. AI mode successfully launched in US and India. AI Overviews now has over 2 billion monthly users globally. You got the eyeballs, right? AI Overviews are driving over 10% more queries for the types of searches that show them. Yeah, I see no issue with that. It's like, yeah, okay, I agree. I tend to use Perplexity more than when I used Google because I get the answers without having to click all the links. So I tend to say, well, it's so much easier to use it now because it's not a big undertaking. I don't have to save it for later saying, well, I'll search for that later because I know it's going to take 15, 20 minutes to find what I want. I get it right away. So yeah, I can agree with that, but where's the clicks? Where's the advertising? Gemini 2.5 family of models and the successive VO3 video generation model, which has been used to create over 70 million videos. And 192 closed at 192 and saw a slight increase after hours. I think they were 194, 195 on Friday, playing in around that level. Let's go back up to their earnings per share, 231 for the quarter. Multiply that by 4, you get to $9.20. If you multiply that by 20, 9 times 20 or 180, 21, you'd be at close to the 192, and that's without any growth. If you have the growth that they're showing, 22% improvement from previous year. So if you assume, well, let's say they're going to grow that another 20% over the next year, average that out over the quarter and say it's an average of 10% growth over the year on $9.20. So they'll be somewhere around $10.20 a share. Then on a forward basis at a price of $195, you're trading at about 19 times forward earnings on a company that's sitting on almost $100 billion of cash. Incredible. Research and development expenses increased by 16%. That's what you would expect. Autonomous driving unit Waymo surpassed 100 million miles driven autonomously on public roads, expanding its operations to new cities. In Tesla's report, they reported that their robo-taxis in Austin from the middle of June to the end of June logged a total of 7,000 miles. Substantial 65% increase in general and administrative expense. When I asked Notebook LM for the main points, it didn't say anything about general and administrative expense, but when you look down the statements, you see this big jump in general and administrative expense. They break out selling into another line item. There's selling and marketing, and then there's general and admin. That's a big increase. So this is where I then use Perplexity and I ask Perplexity questions. What's going on here? Legal settlements, which we can think of as a one-time issue. And here, should remain aware of ongoing antitrust rulings. It didn't really say anything about that. And I said, what about its antitrust? What's going on there? Because some of that isn't settled. So overall, it gives you a really good overview of the important things, but you do have to nudge it a bit. And then whenever you do have questions, you can go to the source documents and look it up, or you can just go to Perplexity. What antitrust issues is Google currently facing? And it will search a whole bunch of sources for you. And it tells you, U.S. search monopoly case, U.S. ad tech monopoly case, ongoing EU antitrust action, and gives you some discussion of the scope of remedies. But these are still outstanding. Then for the increase in SG&A, again, you can go to the 10K and you can look it up. You can read Or you could just ask Perplexity. In the most recent Q2 2025 earnings report, Alphabet reported a substantial 65% increase in general and administrative expenses. I want to show you something. Let's go take this off the screen just to show you what I've been doing here. Let's find where that statement was. There it is. A substantial 65% increase in general administrative expenses. These are prompts. I've tried to word these in terms of prompts as opposed to writing a report. What do you need a research report for? I mean, you need the headlines, you know, the big points. Okay, that's good. I want to dive more into this. Well, it's already as a prompt. So let's bring this back on and look what I've done. In the most recent quarter earnings, Alphabet reported, and just put it in quotes. Cut and paste, put it in quotes. Why? And it'll tell you. Primarily due to significant legal costs, most notably a $1.4 billion charge related to the settlement of various legal matters. Yeah, but the increase was over $2 billion. This is 1.4. And it gives you some ideas of what you can do, reasons for increased legal expense. So I hit plus, and there it is. So 1.37 billion. This was settling a lawsuit with the state of Texas over alleged data privacy violations. 500 million shareholder lawsuit settled in May. 500 million there. High-profile jury verdict in San Jose, California, ordering Google to pay 314 million over mobile data privacy claims. There's the 314. There's the 5 for 8. Add to the 1.4. There's the number. And I didn't have to go to the source documents. And I have pretty good numbers. You go to the source documents to check for this, you don't get that kind of granularity. Thank you, Perplexity, on this one. So combining Notebook LM, asking for the big important points. If you don't like 20, go to 25. Or you could just download the sheets that we're going to have. I've got about a dozen of them done, of ones that, because it's slow, right? You got to fact check everything to get your prompt right. For the third quarter, I'm hoping to do about 100 of the S&P 500 companies, but by this time next year, have the process down that I can do one for every single company that reports earnings, because hopefully you can write a script to get the documents you need to put it in Notebook LM to generate the prompt. At least in a year, I'm hoping that the technology will be there. Let's have a look at some of Google's statements, shall we? Let me bring this onto the screen here. And let's start here. This is the consolidated statement of income. Here are the revenues, and you have to go to the farthest column. There's 2025. Typically, we're used to seeing 2024 and then 2025 over here, but it's reversed. So if you didn't look and you were reading, you're going, they went from 96 to 84. That's not good. Revenues, 96 billion. This is just for the 3 months ended. Cost of revenues, 39 billion. Some of the money in there is for that big payment to Apple, right? Research and development, sales and marketing, 6.7 to 7.1. That's not unrealistic. General admin, 3.1 to 5.2. That's what caught my eye. And I said, hang on a second, that's a big jump. Notebook LM didn't say anything about that. And that's where we found out, legal settlements. I think we have more breakdowns for in terms of where the revenue does come from. Have a look at their balance sheet. Cash and cash equivalents, marketable securities as of June 30th, 2025, $95 billion in cash sitting on the balance sheet in a battle where your army is the size of the cash you have. This is why I think it is inevitable that Google and Facebook are going to be one of the last ones standing, just because the cash they can bring to this. As soon as you run out of cash, it's pretty much over. But just to dismiss the asset light comments that we get about technology companies, they're not that asset light. Property and equipment, 203 billion out of 502 billion, 40%. You can add operating lease assets onto that, because that's just another way to get access to assets that you need. So 217 billion, and roughly about 45% of your balance sheet is in assets. So you are going to get operating leverage. Their long-term debt, 23.6 billion, that's nothing. Leverage can come from financial leverage or operating leverage. 23 billion in long-term debt versus almost 10 times that amount, 9 to 10 times that amount in assets. This is a company that has a lot more operating leverage than financial leverage. Okay, let's just scroll up here. Google search 2025. This is the revenue, 54 billion from 48.5 to 54.1. On the prompt sheet, we saw that they had reported double-digit increase in search to 54. Total revenues of 96 billion, as you see down here. This is more than 50% is directly tied to search. And URL search, I think, is disappearing, and it's going to disappear fast. I no longer use it, really. I use Perplexity unless Google gives me a compelling reason to say, oh, I don't need Perplexity. Google has it right here. It's the same thing. And it hasn't so far. The AI overview is still really not enough for me. I like Perplexity. I don't get any ads thrown at me, but I do pay for it. It's $390 a year I paid. You don't have to pay for Perplexity. You only have so many searches. If you have the Pro, you have all the searches, and then you get Perplexity Labs with it, which is, it's all right. I don't know that I would pay another $390 again for it. It's all right. I'm hoping Google solves something with AI search. YouTube ads, even though it is a big number, 10 billion, it's dwarfed by search. What else do we have in here? Google subscriptions, platforms, and devices, 11.2. So the big question is, could they have enough subscriptions that if you subscribe to Gemini, let's say, you'll get AI search. Let's say they do have some AI search, but they can't figure out how to monetize it. Would you be willing to pay $40 a month? And would subscriptions, can it absorb that 54 billion somehow? That's the risk, right? You're looking at a big part of its business, $54 billion in revenue that could be decimated in 12 months, unless they get clever really quickly. Looking at it from the advertiser's point of view, to still have 2 billion active users a month, it's still the center of gravity for advertising. So from an advertiser's perspective, if you don't have search, what do you have? How if I have a website, how do I drive traffic to my site in an AI search world? If I'm not in the language model, if there's no discussion of me in the language model, how do I drive traffic to my site? Maybe that's where the revenue model is that I then say, well, I have to pay Perplexity and all of these places to give me something, to help me show up somewhere in the discussion. How many businesses out there rely on Google to drive traffic to their site through keyword optimization and different things like that? That all disappears. From the advertiser's perspective, they really want Google to come up with an answer for this. And they do have the eyeballs right now, so I'm not too concerned about that. It is an issue, but I guarantee you Google's got a war room full of a lot of people right now saying, what do we do? How are we going to do this? What are the possibilities? How do we get this done? The bigger threat to Google is the antitrust suits that are out there right now. I think this is less of a threat because I'm absolutely sure they're more than well aware that more than 50% of their revenue comes from this. So they are working to solve this. Other bets, lost 1.2 billion. That's where Waymo happens to be, down in there. You have Google Services, 33 billion. This is operating income Google Cloud, 2.8 billion. Even though it's growing fast, 1.1 to 2.8, it's got the bigger growth in here. 29 to 33, this will grow slower because it's just such a big number, but it's in here, right? Google Cloud and Gemini. How from quarter to quarter, I expect those numbers to just grow incredibly. But at 19 times forward earnings, I kind of think this is worth looking at. So I did sell some 195 puts on Friday. No, sorry, I did not. I sold $210 puts for, I believe it was October. I think it was October. I sold $210 puts, and I think they were $18 each when Google was at 195. That would give me a price of 192, which is my thinking is somewhere around 19 times their forward earnings. There we are. As far as these, I got a bunch of these done. I don't know what you think of these. I was thinking just give them away for free. And in giving them away for free, well, I'm going to stick some advertising in there. Because, of course, they'll be shared and they'll find their way around. I figured what a great place to stick some advertising. In the comment section, tell me what you think. If you like it, I'll set up a Dropbox and I'll start dropping these into the Dropbox, and I'll leave a link of where you can get them. For now, if you have the access to Discord, I will drop the ones that I've done into the Dr. Mark feed. You can't leave any comments there, but you can download them from the Dr. Mark feed. And that's it. What I'll do next Sunday is I'll highlight another company. I think this is fun, looking at one particular company a week, because every week I think, well, what's my story this week? What are we going to talk about? What's new? Sometimes there's nothing new to talk about. But every week you can highlight a company with one of these AI top 20 lists and combine it with Perplexity. Write these up in sort of prompts so that you could just cut and paste in Perplexity, say, tell me more, tell me more. Oh, well, that's it for this week.